I'm back again and I'm on my own again. I quite enjoyed doing the last solo pod as much as it's great interacting and talking to other Bitcoiners. Sometimes there's things that I just want to get out there on my own rather than necessarily having a guest. So we've had quite a lot of volatility in the Bitcoin Treasury Company shares of late. We've had people that were fortunate enough to get in at the IPO and have seen massive gains. We've also seen people who got drawn into the FOMO, the fear of missing out, and maybe even bought in at or very close to the top and are now nursing either some unrealized losses or have sold and crystallized a loss. So I just wanted to put together a podcast exploring the emotional and psychological impact of investing. So not really giving financial advice. This definitely is not financial advice, but maybe just some guidance and some help that some of you might reflect on and help change the way that you approach your investing, and FOMO on the way up and that gut-wrenching fear on the way down, to just try and be a little bit more mindful. As much as I'm not a qualified advisor, I do have 25 to 30 years of experience in investing, and I've made some ridiculously bad decisions and some pretty lucky good ones. So I think I've got enough experience to at least share my thoughts, and there might be some bits in here that you find useful. Talking of finding useful, if you do find this content valuable to you, then liking and subscribing and maybe sharing this with a friend would really go far to help spread the word, get more people watching, which is only good in the long term for me. So thank you very much if you decide to do that. Okay, so first of all, I'm going to talk about the emotional side of investing. Now, I'm sure most of the people watching this have bought a share, have bought some Bitcoin, have bought even, dread to think, some crypto of some kind, and the price starts absolutely ripping. And you get the adrenaline pump and you're thinking, I'm an absolute genius. I bought this thing. It's flying. I'm going to retire in a week's time. I'm going to be able to buy that Porsche. I'm going to be able to have that amazing holiday. And then it all goes tits up. Maybe we haven't all been there. I certainly have. So what I think is really important is to recognize when you start having those real extreme, frothy, emotional feelings, it should be a bit of a trigger warning that things have got pretty crazy in the market. And generally, when things are going up that hard, that fast, often in an unexpected way, markets are rational. And even if you're not thinking this is never going to stop, there's probably people with smarter minds and deeper pockets than the rest of us who make sure it does. Or people that are just taking profit and then it pushes the price back down again. So I'm going to come on to some strategies in a little bit, but I think in terms of just recognizing your emotions, when your heart's beating and you're feeling like this investment is never going to stop going up, just take a little bit of a check on yourself and just acknowledge that this is probably not sustainable. It's probably not going to keep on doing this, and refer back to the plan that you put in place, which again, we're going to come on to shortly. I think the next thing is the emotions when you bought an investment, again, a stock, share, Bitcoin, crypto, whatever it may be. Don't touch crypto, obviously. That is financial advice, and Bitcoin only. So, but if this investment that you purchased with goodwill and strong intent and belief this it's going to go much higher, suddenly starts to dive, you get that gut-wrenching, sick feeling in your stomach. Why did I buy this piece of shit? Why did I invest in this now? Oh, if I'd bought it an hour, a day, a week, a month later, I'd be so much better off because I'd be buying at the bottom, and you feel like a complete idiot. Those two emotions that I've just described are exactly that. They're emotions. They're not right. They're not wrong. You're not a complete genius. You're not a complete idiot. There's usually a grey area in between. Sometimes you can be a genius. Sometimes you can be an idiot. But most of the time, it's just the feeling that you have at that point in time. Both of those emotions can be really dangerous and can lead to decisions being made that really aren't good for your financial well-being mentally, or your Bitcoin stroke fiat balance in the long term. So when things are really frothy and the price is always going to keep going, you may end up doing stupid things. You might use money that you need next month for something, but you're going to put more in now because it's going to keep going up. Then you can sell it and take it out and you've got more money. Or you get in debt to buy more of this thing that's never going to stop. Or you sell existing investments that have done okay for you or maybe haven't, but you're thinking, I just need to find more money from somewhere because I've just got to pile into this thing. It's never going to stop. And that is so dangerous. It's the wrong time to be doing that. It's not intentional. You haven't really thought it through. Yes, sometimes it can pay off. I'm not saying these things never pay off, but when things are so frothy that you're having all of those emotional reactions that are causing you to think, where can I scrabble some extra money from? It should be a signal to you just to stop and think and reflect on whether you're really making the right decision for the right reason. Likewise, when things are crashing, you can make various bad decisions, such as cutting your losses and selling at a loss and realizing that loss. Now, in the long term, that might prove to be the right decision. If whatever you bought continues to go down and goes to zero, then selling it for anything was the right decision. However, if the investment that you've made, you have conviction in, then if that conviction hasn't changed and it's just a market movement and you were just a bit unfortunate buying when you did, then selling to realize a loss is going to make you feel even worse when it recovers and you realize if you hadn't sold, you'd be in profit now, but actually you banked a loss. Likewise, you might sell other investments that are doing well to pile in more to this investment that's taken a bit of a dip. Again, that could be a great decision. If that is a temporary dip and the investment that you're buying recovers and goes into growth, then you're going to feel like a genius because you sold something you bought in at the lower price and it's recovered and now you've made even more money than you did before. The point with all these things, though, is you should be thinking about these things in advance where you can, not making short-term reactionary decisions that you might live to regret and you're doing just on the fly without really thinking it through. So how can you plan for these things? How do you know in advance how you should be reacting when shares or investments go up or go down? I think where possible, you should be as intentional as you can. So let's have an example. Let's say you're going to buy £1,000 of Bitcoin. If you're buying that, as you probably should be for the long term, to hold it for the value of the Bitcoin in 4, 5, 6 years' time, then it doesn't matter really. Your only decision is, am I going to dollar cost average and put that £1,000 in over a course of hours, days, weeks, maybe even months, or am I just going to put it all in and have confidence and conviction that the price is going to go up over 5, 6 years' time, which is when I plan to consider using those funds? Then it doesn't matter. You may decide to just smash buy your £1,000 now. If you know deep down that you're not going to be selling that Bitcoin in a rush, in a panic, if it goes from $100,000 a coin to 60, or if it goes from $100,000 to 150,000, then really it doesn't matter because you're in for the long haul. If, however, you're thinking Bitcoin looks a bit low at the moment, it's just had a bit of a dip, it's going to fly, it's going to double in price in the next 2 weeks, I tell you what, I'll put that £1,000 in that I've set aside for the new tyres on my car that I need to do next month. Then it will double and I can take my £1,000 out, and aren't I a very, very clever person? That is massively high risk and is just not a very clever thing to do. Again, it's gambling, basically. I'm not a fan of gambling. I've been a gambler in the past. I don't really gamble anymore. I've never gambled with big money, and I've never gambled to the extent that it would really significantly affect my financial standing. But gambling isn't a smart way to invest. So again, just be intentional. Think about, if you're putting this money in now on the basis that you believe it's going to go up very sharply, very quickly, that's basically gambling. It's not really investing. And just be aware that those funds might not be available or might be worth less than you put in the first place. If you're buying a share that maybe is hit an all-time low, or it's a speculative investment, it's relatively low, you put some money in, but you think it could spike, but then I'm not sure about the long-term security of this investment, then there's lots of different things you can do. One of the things I've found has worked best for me, again, this is not financial advice, but let's use the example again. You put in £1,000. Let's say you buy a share at 10p and you put £1,000 in. You may decide that when it gets to 15p, you're going to take your £1,000 out. And what you've got left in there is you're playing with profit. So even if that then goes down to zero, you haven't technically lost anything because you've taken out your initial investment. So recovering the cost of your initial investment is one way to psychologically help you deal with increased volatility, upside and downside. The risk of that is if you take your initial investment out at, say, in this example, 15p, then it goes to 20, 25, 40, 50p. You need to be at peace with the fact that you took your initial investment out for good reason, and don't start chasing those gains with FOMO, fear of missing out, because you took your cost out earlier on. Again, all of this is about being intentional before you make that initial investment. What are you going to do? What are you going to do if it goes to 15, 20, 30p? You may decide you've got a higher threshold. Again, use that example. You put £1,000 in at 10p. You might say, I'm going to take £500 out when it gets to 20p. And then I'm going to sell 10% of my shares when it gets to 30p, whatever it may be. None of these things are right or wrong. They're only proved right or wrong in the fullness of time. But having some kind of strategy at least protects you from having to make irrational, quick decisions that are often the worst decisions that we make in investing when the price goes crazy high or drops low. So again, let's use that example. You bought £1,000 at 10p. If it goes to 5, what would you do? Cut your losses? Sell it all for £500 and say, I took a £500 hit on the chin, I'm just going to have to take that? Or do you say, no, I'm going to write it out. I'm just going to keep it in there. I'm prepared to lose the full 1,000. Or if it goes to 2.5p, then at that point, I'll sell it all and I'll take 250 back out and I've lost 750. Again, none of these things are right or wrong. They're decisions that you have to make for yourself. But they are tactics and approaches that I've found have worked for me in the past, and just make the executions of that trade just become more methodical and mechanical. You're not having to think about them because you've thought about them in advance in a very calm, measured way before things get really frothy or before things start falling apart. So you then just execute on that plan. You can always change that plan. Just because you have a view of taking out your cost base at, say, 15p, it could get to 15p and you think, I'll just take half of it out. Again, you're starting to compromise, you're starting to be swayed by the emotions again when it moves, but we are all human and you can't always stick to a plan, even though it was, maybe the right intentions. The other thing I think is really important is to not be taken in by so-called experts on X or anywhere you might chase your social media. So if you're invested in a share and it's doubled in price and everyone on X is saying, man, this is going to quadruple in the next 2 weeks, and you think, I was going to sell, but I can't because all these people are saying it's going to go up 4x. If I sold now, I'd be an idiot. Maybe that might happen, but just think these people often have ulterior motives. They might even be being paid by the company. They are probably owning the shares themselves and hoping that they can get liquidity to sell their investments themselves to people like you who might be wanting to buy more because it's going to 4x. So just be cautious. Find people you trust. Find sources of information that you can do some further research on. Do your own research. Don't just trust bros on X who tell you hodl and it's going to 4x, because whilst that can happen sometimes, more often than not, it doesn't. Also, don't be drawn in by people sharing their gains and kind of feeling you need to compete with that, or that you've only made a 2x and these people have made a 4x, aren't you an idiot? People tend not to share the things that haven't gone well. And often people share things that have gone well for them, but kind of maybe embellish the truth a bit. They aren't necessarily up as much as they say they are. They might be on this one investment, but they could have lost 10 times that amount on other investments that they just aren't talking about. So again, stay focused, concentrate on yourself, concentrate on what you're doing, and don't get suckered in by what other people are trying to project and try and draw you into. The other thing that's really common in investing is chasing losses. So as much as you might decide something is rapidly going up in price, you want to put more money into to keep chasing it because it's going to keep going up. That's not always the best thing to do. Again, sometimes it can be. The more common approach is that people start putting more money in when an investment starts going down because they think it's going to lower my average price. It means I can break even more quickly, and they just pile in, keep putting in money that they maybe haven't really got by using, emergency funds, using their holiday money, using or selling other investments to put more into this investment that's going down in price. Sometimes if you have full conviction, it might be the right thing to do. But again, stop, take a deep breath and just really challenge yourself. Is this the right thing to do right now? Or am I just kidding myself? Try not to be someone else who throws good money after bad. The other thing when you're thinking about how much to invest is consider your overall financial situation. If you're single, living at home, and all you've got is your own income to worry about, that's a very different scenario than if you're, say, like me, late 40s, family, house, responsibilities. I can't afford to put money in to an investment that puts any kind of risk on my family. I'm just not prepared to do that. It then completely becomes gambling. That's a really dangerous place to be. There isn't guidance on this. It's not like use X% of your total net worth. It's very individual, and you need to decide that for yourself. You know your situation, you know your risk profile, you know your emotional stability when things go flying or when things start falling. But just stay clear to your path. Make sure that you're not risking any kind of capital that you can't afford to lose in something that you don't have full conviction in and that you might have to accept has got quite extreme volatility. We then come on to tax treatment. So if you're making investments in an ISA, which is an individual savings account, then all of the gains in that ISA are completely tax-free. I'll say that again because not everyone realizes this, but every single penny that you make in an ISA, when you buy and sell something and realize profit, all of that is tax-free. You can take it out of your account into your bank and HMRC will give you a virtual tap on the back. They won't come after you to say, hang on a minute, where's my share of those gains? It doesn't work like that. That is the beauty of an ISA. You have a £20,000 limit per annum per person. So a married couple can use £20,000 per person if you're fortunate enough to have that amount of money. But obviously there's only certain things you can put in an ISA. But if you're looking at buying stocks and shares, you can open what's called a GIA, which is a general investment account. If you don't have an ISA, do not open a GIA, because when you buy and sell things in there, those are all taxable gains. So if you make a £5,000 profit, you should be declaring that to the taxman and paying capital gains tax on some or all of those gains, depending on what else you've done in the year. That's one reason why some people like me who are invested quite heavily into Bitcoin also choose to invest in ISAs, because the gains that you get in an ISA are completely tax-free and might mean that you can use some of those gains to buy more Bitcoin, or you can use some of those gains to avoid you having to sell any Bitcoin. So Bitcoin maxes will turn their nose up at anything that involves fiat, but for me, it's just a rounded approach. There's no right or wrong. It's what's right for you on balance and where your risk thresholds and your personal views are on this kind of thing. If making tax-free gains in an ISA makes you feel dirty and you just want to have everything sitting in spot Bitcoin in self-custody, fill your boots. But be aware that, if you have to sell any of that Bitcoin and you bought at a much lower price than you're selling at, then you might be liable for capital gains. One really important consideration here is your conviction on your investment. And I think this does bring nicely back round to Bitcoin. This is the Bitcoin and Me podcast after all. So for me, when I put any money into Bitcoin, as far as I'm concerned, that's the safest place for me to have my money. Bitcoin is money. So once I've got fiat, where is the best place to put that for the long term? It's Bitcoin, in my opinion. However, I'm not 99% allocated to Bitcoin. I can't afford to be. I have fiat demands and I do use ISAs in a much lower extent than I used to, but I think they're a very smart way to play the fiat game and exploit the tax system effectively by trying to invest in shares that are going to give you some growth, that give you more money to play with. That means you can stack more Bitcoin or not have to sell your Bitcoin. However, if you're buying shares in a treasury company, there's going to be volatility. And I think there's more risk of you going into investing in a treasury company without the level of conviction you might have when you buy into Bitcoin. That's certainly the case for me. I've got shares in treasury companies. I've been in strategy for 2 years or so in my SIP, in my pension. I was fortunate enough to get into the IPO of Smarter Web Company in my SIP, and then subsequently did buy some in an ISA when one of the follow-up raises was issued. But I look at those as more speculative. I don't know if I'll still be holding those shares in 5, 10, 20 years. If they carry on going up, great. I've already put my own plan in place, which has taken out my initial cost and banked some profit. And okay, it's been massively volatile. So for anyone that isn't aware of Smarter Web Company, the IPO was at 2.5p. They then raised more money at 16p, 27p, 49p, and 81p. And then it, in a very short space of time, rocketed up to £6.30 at peak. And then, inverted commas, crashed back to around £2. Now, if you bought at 2.5p, £2 is almost 100x. So on any measure, that's doing pretty well. However, if you bought at £6 and you put £1,000 in, you've got 300 odd quid to show for that. So you're going to be hurting right now. And, you may feel it's never going to get back to £6. So do I just sell now at £2? Again, not financial advice. You can only answer that for yourself. But these things, in my opinion, when you're investing in anything other than Bitcoin, having a plan for your entry and exit and the different scenarios when the price levels kick in is more important than anything else, because it helps protect you from those crazy euphoria that makes you do silly things, or that gut-wrenching dread and abysmal feelings in your gut when the price just absolutely crashes and you see your net worth shrinking in front of your eyes. If you're sticking to a plan, then the chances are you've already protected yourself to some extent when that happens. Anyway, that's enough for now. Hopefully that was vaguely interesting and slightly useful for some of you. If it was useful, please do share and consider subscribing. Someone else might find it interesting and useful too. Okay, I'll be back with another guest soon. So cheers. Thanks for now.